You see, that wave 5 projection has us butting up right against this 10-year resistance that we keep meeting, right? We met it once in May 2010, again April 2011, again for a period of time between December 2013 and January 2015, and then once again January 2022, and I believe that we're going to do it once again in Q1 of 2023. Okay?
It's K1 and double vest. Get next, please protect. Get a brace and find your place. It'll only take a sec.
We're going to come back to Bitcoin, so don't worry. Traditional markets are very, very correlated with cryptocurrency markets, especially now. Especially after COVID, right? Everything kind of went to the side of being heavily correlated. So let's look at the SPX, okay? We're on the hourly time frame. Again, when we do our analysis, it's best to zoom out, okay? Get some context. I have context, but for the purposes of the live stream, I will I will present it once again just to make sure everybody's on the same page. Okay, you'll see some drawings here, so just ignore them. I will explain. Okay, this is how I've marked up this S&P 500 index chart. Okay, it's on the daily time frame. First thing I want to do is this. I don't want to take time and energy into trying to read the entire history of the chart. Okay, I'm not trading this. I'm using it as an indicator. Okay, I'm not trading this. I'm using it as an indicator. I want to know more or less with a high degree of probability when these traditional markets, which I'm using the SPX as a proxy for, are going to go up and when they're going to go down. Okay, this to me is very clearly a flat correction. Okay, and that's a big flat correction. So for me, everything before this is a certain wave and everything after this is a certain wave. Okay, that's my first read on this market. Okay, so whatever happened between 2018 and 2020 demarcates two different markets. This was a corrective market. This is obviously an impulsive market, and this was an impulsive market before. Okay, now that I have that sorted, I'm going to focus my energies on reading this right here, this trend. Okay, first I want a general idea as to how long this took. So I take my ruler and I see that from March of 2020 to December of 2021, for about 650 days, which is quite a long time, you had uninterrupted growth, essentially up only price action for 650 days. Okay, that is pretty hot. I mean, that's an overheated market. All right, and in that time, the market went up 108%. Okay, so that's nothing for crypto, but that's a lot for equities. Okay, so what I want to do also is I want to see on the momentum indicator, going on the monthly time frame, what that looked like. Okay, so indeed, going on the monthly time frame, from that big correction, which completely bottomed this indicator out, I'm going to make it bigger. This stochastic RSI, right, was bottomed out after we finished that. We completed that big ABC correction. We basically went up for 650 days, and indeed, our momentum indicator, our stochastic RSI, topped out. It became oversold. Okay, right there at the end of that 650 days, and so from then, we pretty much bottomed out completely. Okay, that tells me this, without even looking at this, I can tell that's an initial break of structure. Okay, because this is a strong move down, really breaking that uptrend. Okay, but our momentum indicator is showing us that it's basically completely reset after 650 days. That move right here, and let's just measure that really quickly. So this move a 24% move to the downside, it completely reset that 108% move, taking 650 days. And that move didn't take too long. Although it took 650 days to get there, it took only 243 days to bottom out the indicators, okay? So what can we expect? After a swift move down, typically, and this is basic Elliott wave theory, impulses happen in 5, right? And corrections happen in 3, right? That's why we talk about flat corrections looking like this. Sometimes it's a flat correction, sometimes it's a zigzag, sometimes you get a composed, WXYXZ or WXY. They're all flavors of 3, okay? So we always want to think in terms of 3 when we're looking at corrective sequences. Even this move itself was a corrective sequence in 3. It's an ABC zigzag, okay? Now, what's important about this is you have to also understand we can use time, use time in Elliott wave theory to shore up our analysis or to really get a handle as to what's going on. Not just price, but time. Remember, if the uptrend took 650 days and this correction took only 240 some odd days, let's say 230 days, something like that, then we know that it can't be over. This is just one part of a 3-wave move. And this is why I have this ABC correction kind of noted or sketched out, because it's not possible that you have 650-day move followed by a 200 and some odd day move, and that 200 some odd day move is an exhaustive correction of that 650 days, right? Why? Because the principle of Elliott wave theory states that waves of a same degree are comparable, or they're equal or proportionate in time and in price, right? Remember, you're not just doing price analysis, you're doing time analysis. Everything that you're doing on a chart, you're looking at price as a function of time. So don't discount the time. And in appreciating the time, we know that we will need approximately 650 days for this flat correction to go. Okay? So that's what we're looking at here. Now, why do we have it coming up here and being an expanded flat, or a flat correction where the B wave, it breaks the plane of the A wave? Very simply put, that's what you typically get. B waves don't typically look like flat corrections, right? Although Ralph Nelson Elliott called them flat corrections, and he called a flat correction that looked like this an irregular flat, that's actually what we typically see. So, you would say that that's a regular flat. A regular flat is where the B wave moves up on the A wave. And one of the reasons we think it's going to move up, we said yesterday, I'm not going to repeat it exactly, is from what the first wave, projecting the first wave that we've gotten here, and I'm going to zoom in a second and show you that. So let's not talk about that right now, but let's talk about the second reason. The second reason is simply, go on log scale, you see that there is a trend, and a trend that you've been playing with since 2010, and that trend is this dotted line. And this trend has served for the past 12 years to contain the price, right? Expect this trend to be retested upon the counter wave. So the A wave is the initial breakup structure, the B wave is the counter wave. The counter wave will likely retest that, okay? Now, this is why the SPX or equities are up, and this is why we can expect them to go up. Also, look very simply, keep it stupid simple. This momentum indicator, one of my favorite momentum indicators, if not my favorite, the Stochastic Rsi. What does it tell you? It showed you very accurately that after this correction, and once again, do you see in this flat correction that you have down here? Look at how that B wave went up and broke the plane of that A wave. Do you see that? It's again what we can expect. Look at what happened since then. You got positive move up on the Stochastic Rsi, and it topped out. It topped out almost exactly at the top. So let's say you knew nothing about technical analysis, you just used an indicator, and you decided to buy at the bottom and sell at the top of a high time frame Stochastic Rsi, you would do very well. Sometimes, the simplest analyses are the best. It's just people have to wait. That took 650 days to wait for the price to get up into this oversold territory. Okay? And then you would have not done anything. You would not have bought until it got back down to overbought territory, and then you would not have done anything until it got into oversold territory. It's oversold right now. It's right down here, okay? And we can actually check specifically where it's at. Where is it? Here? Nope. Is it? I don't use this often, so I forget where it is. Yeah. So the Stochastic RSI right now, the K line's at 11 and the D line's at 6, okay? Anything below 30 is technically considered oversold, okay? So right now we're oversold. This is another reason, very simple reason. I could have started the video and ended the video and just saying, look at the Stochastic RSI on the monthly time frame. On a high time frame, we're clearly oversold. The price is going to go up, okay? So that's what you see on the high time frame on the S&P 500, which we're using as a proxy once again for traditional markets. Now, if you jump down into a smaller time frame, why have equities bottomed? Okay, and because we've already gotten an impulsive wave. Okay, we've already gotten an impulsive wave. Here's that A wave that you saw on the larger time frame. All right, that 3-wave move right here. Okay, ABC. That's your zigzag down. And following that, you did AB basing for a B wave. And that B wave, basically this is the base of that B wave. Okay, so it's corrective. So that's 1, 2, and now this is the third wave or the impulsive wave of your B wave. And you've already put in the first of 5 waves. 1, 2, 3, 4, 5. Or actually, does it go 1, 2, 3, 4, 5? Okay, something like that. Okay, so it's an extended 5th wave that you got. And now your initial break of structure, or no, I'm sorry, that is the correct count. I think wave 4 is up here. Okay. So that's a 5 wave, run-of-the-mill. Wave 1 is comparably sized to wave 5. Wave 3 is the longest of the Elliott waves, okay? And now you have a run-of-the-mill wave 2. What's a run-of-the-mill wave 2? A run-of-the-mill wave 2 is a zigzag where people don't really believe in the change in trend, okay? So they sell into strength. So that wave 2 is typically sharp, and it's typically retraces between the 0382 and the 0618 Fibonacci retracement of that first 5-wave impulse. Okay, so if you take your Fib retracement tool from the bottom of this purported 5-wave move all the way to the top, you see exactly between the 0.5 and the 618. You're in the golden pocket right here for this Fibonacci retracement, okay? So that is why equities have bottomed. If you want to zoom in even more, you should now be able to observe a bottoming, some AB basing, some consolidative and reversal kind of patterns here. So now on the 15-minute time frame, guys, you notice how the proper analysis goes from high to low. You want to go from high to low because you need context. You understand that looking at something, maybe if you're good enough, you can look on a small time frame and just understand the larger context. But you want to be prudent. Look at a high time frame. Look at the daily, weekly, monthly, whatever. Understand where you're at and what you're doing. and then progressively go into smaller time frames to really suss out the price action, okay? And so here, our assumption is that, just like I showed with the retracement, this three-wave move, this zigzag, right, which you have here, let's see, A, B, C, okay? Or is this, maybe this is the end right here, okay? I think it's A, B, C right here, okay? So this is your three-wave move down, and from here, I believe you start your consolidation reversal pattern, okay? I'm not exactly sure. Let's see. I don't know about that. I think I was right the first time. I think it goes A, B, C all the way down here, okay? And basically what you have here is your consolidation reversal pattern, okay? And so let's zoom in there. Guys, don't forget to like the stream. Shout out where you're listening, watching from. Always appreciate it. And if you didn't have a chance to catch this, you know, you can always rewind. These live streams are rewindable. So don't worry about missing anything. That's your initial break of structure. I think what you're getting here is a composed B wave right here, okay? It's tough to say. It's tough to say because I don't have that much data. It's not like the cleanest chart, but it's very likely that you're getting some sort of AB basing here, and that would be your first degree. But it's also possible that this initial break of structure, and this is your B wave right here. This is your A2 or small a, and this is your small b. It's also possible that that is the case, okay? That you're pretty much rounding out your AB basing, okay? Let's see if we can't get more insights from our Stochastic Rsi. And our Stochastic Rsi, let's see, on the larger time frame, should tell us where this trend ended. Okay, just judging by the candlesticks, I think I was correct in saying that this was the end of our trend. This was the end of our zigzag, because here you have a strong wick to the upside, right? You have a strong bullish hammer candle denoting the exhaustion of trend. And I would turn on the volume indicator, but I don't have volume. You can't see volume on this chart for some reason, okay? So once again, if you're looking at the small time frame, S&P 500, you will see that we are bottomed out. And remember where we are, okay? We are between the 0.5 and the 618 Fibonacci retracement of this larger move, okay? Let's zoom back out just to prove that to ourselves. The golden mean is called the golden mean for a reason, okay? It's very, very probable and very likely that whatever this retracement is, and people calling this a fake rally are right and wrong. They're right in the sense that it's not an actual bull run. It's a corrective, it's a counter-corrective move in a larger retracement. So if you don't know, if you're not chart literate and you're not careful at how to trade, it's best to sit it out, yeah? Because if you're calling this a fake rally, in a sense, yes, it's a fake rally because you've broke initial structure here, right? This was your initial, this was your initial break of structure. So whatever you did, the 650-day party of up-only price action is essentially done. What you're gonna do now is you're going to correct and then counter-correct and then finish out your correction, okay? And we're gonna get to that in a second. So yes, it's a fake rally on the larger time frame, but not really, because this still is going to translate into 6 to 8 months of positive price action to about 5,600 points, right? Something like that. And I'm going to give you an exact sort of projection. And see on the daily time frame, what do you see? You see two things that'll tell you that this is a bottom on the daily time frame. Does anybody see this before I say it? So bust out your stochastic RSI indicator. And again, indicators are best used corroboratively. If you're just using indicators and you don't know how to read price action, do yourself a favor and start learning how to read price action. You will thank yourself. All right, what you can see with the indicator is strong bullish divergence. And I always say the best way to read divergences are with the stochastic RSI. You can use typical RSI, but it's quite confusing. And, there's no extra points for adding to difficulty. Like, you don't need to make your life more difficult. Stochastic RSI exists. Use it. The regular RSI is good for certain things. I don't think it's great for reading divergences on big moves. This is the best. Look at this. On the daily time frame, you have a lower low set here, right? Price action is clearly making a lower low from this inflection point on the B wave, right? Of this wave 2 correction, zigzag correction. And then on the momentum indicator, that was your first bottom, and now you have not yet confirmed it because your K and D lines, the pink or red and blue lines, have yet to cross. Yet once they do, you will have confirmed bullish divergence, strong bullish divergence, right? Divergence basically means there's a discrepancy in what the momentum indicator is saying and what price action is saying. So strong bullish divergence on the price action and your momentum indicator. That indicates, in using stochastic RSI, that you're likely to move up violently, okay? So the indicator is telling us that, and it's on the daily time frame. So that is a big move. It's not 15-minute time frame. It's a relatively large move. Okay. Now, remember, you're in between the 0.5 and the 618. Your typical wave 2 retracement comes to between the 382 and the 618, and most of them come between the 0.5 and the 618. So you're right where you want to be. This is not a fake rally, because if this holds, which it seems like it will, and the indicators are showing us that it will, and when we zoomed in, we saw this price action come down just like a wave 2 would come down, you can project now 5 waves to the upside. So you would project this being wave 1, this being wave 2, wave 3 would be somewhere up here. We're going to measure it in a second, don't worry. Wave 4, and then wave 5. Now, how do you project your waves using Elliott wave theory? Obviously, you don't know, but there are average moves that waves tend to do. On the balance of probability, your wave 3 will hit between the 1618 and 2 Fibonacci extension of your wave 1 and the retracement of wave 2. So we take wave 1, retrace wave 2. We've got the wave 3 ending between 5,062 and 5,361, somewhere here. Okay, let's just put it at the 618, right? Just for the purposes of this projection, right? And again, every projection is a placeholder. It's just a way for you to get your bearings. It doesn't necessarily mean that's exactly what price is going to do and when it's going to play out. People misunderstand this. I do videos every day, and sometimes I make projections, but I always adjust the projections, and the projections give me a good idea as to whether to think long or to think short, to look for longs, to look for shorts, to look to protect my position, to have a general understanding as to what the market is likely to do. Again, we're dealing in probabilities, no certainties as professional traders, right? Now, wave 4 comes between the 236 and the 382 Fibonacci retracement of wave 3, typically, right? Not always, but typically, that's what you get. So it's going to be around here-ish. Let's get rid of this one, not to confuse anybody. So right here, right on the 382, right? See, I do this so much, I can eyeball it. Look at that, right between the 236 and the 382. And now wave 5 tends to be the same length as wave 1. Okay, that's one way to project it. That's a simple way to project wave 5, right? So typically you take wave 1, wave 5 is going to be the same, or more or less the same length. Okay, let's add the line here. make sure everybody can see this. Okay, and then the other way to project, two other ways to project wave 5, technical waves. Wave 5 projects to the 618 Fibonacci extension of wave 3. So you take wave 3, right? That's just our kind of dummy wave 3, purported wave 3. Retracement of wave 4, wave 5 would come around here, the 618 right there. Okay, so that's one projection of wave 5, and then the other projection of wave 5 is inverse 1618, which is essentially the same thing. The 618 and 1618 are the same thing. They're 5 ratio. They're just different ways of seeing that ratio, okay? Inverse 1618 of wave 4. So that would be around here, around 5342. Now, this is the region that would coincide with this 10-year resistance. Let's go on the monthly time frame. And again, mind you, all of this analysis is done on the log scale. Remember that in order to faithfully represent large time frames, large price swings, especially in cryptocurrencies, people in cryptocurrencies should know this, but in traditional stocks as well, you need to turn on the logarithmic scale. You can't look at it on the arithmetic scale, or else your measurements will be skewed, okay? So high time frame reads, log scale. All right, you'll do yourself a favor. You see, that wave 5 projection has us butting up right against this 10-year resistance that we keep meeting, right? We met it once in May 2010, again April 2011, again for a period of time between December 2013 and January 2015, and then once again January 2022, and I believe that we're going to do it once again in Q1 of 2023, okay? Last thing I'm going to do is I'm just going to, and so I deleted the count because you don't need a count. Now, it doesn't matter. That was just a dummy count. Now, again, we want to be mindful of time. Time is important. In yesterday's live stream, I talked about how I'm bullish for the next 6 months, okay? One of the reasons I said 6 months, particularly, it's because 6 months is more or less around the time I have Bitcoin topping, right? I have a date even. And again, it's a dummy date. It's just one of my projections, February 19, 2023. Just like you just saw that we do projections in price. Again, you want to know that everything you're looking at, all this chart information, is on 2 axes of information. It's price against time. So just like you can project price, you can project time, right? It's just as valid, right? Doesn't necessarily mean it's going to happen at that time, but you can do valid price or time projections for your moves, okay? So the first time projection we're going to do is simply a rough one, understanding that this impulse took us 640 days, okay? And so our correction should take us around 640 days, okay? Right? So this is the idea. Around 640 days. Because, according to Elliott wave theory, waves of the same degree are comparable or equal in time and in price, okay? So if this is a wave 1 and this is a composed wave 2, right, a flat correction, wave 2 flat correction, this took 640-ish days, that should take 648 days. If it takes 600 days, it's still comparable. Comparable means comparable. It doesn't need to be exact, but sometimes it's literally exact to the hour, okay? If you're doing hourly chart analysis, sometimes you get those. So that's our first analysis. Right now, we've been in this initial break of structure, this A wave, for already 210 days, okay? And, we already put in the first wave up for this B wave. So 210 days, 640 days, that's about 430 days left, okay? So 430 days left. Not all of that is going to be upside, okay? A bit of that is going to be this impulse to the downside. So let's say that maybe half of that time that's of those 430 days of this larger ABC flat correction, maybe 200 days, or 180 days, which is 6 months, 200 days, which is a little over 6 months, that is going to take us up to this resistance of 5,600, which is where I see the SPX going in the next 6 to 7, maybe 8 months. Okay.
Only take a sec for the damage to begin. Wreaking havoc on eardrums. We cold getting dumb, getting your crazy style. Late night, height division, we be moving with precision. With 10 spots popping making some decision about hitting them one at a time with these ill rhymes. My love at the door, free drink.